Hey everybody, welcome to Trading Capital's daily analysis of the US dollar and the S&P 500 and QQQ or Nasdaq. So, the first thing I'm going to ask you, were you prepared for this hard reversal down and surge in the dollar and bounce in interest rates? How could we have known the jobs report was going to be coming in way hotter than the market expected? Basically, if you look at the jobs report, it came in at 517,000. The estimate was only 187,000. The high estimate was around 300,000. So we smashed out even the highest of expectations, which is why the dollar has surged completely. So, in terms of why and how did we know the dollar was going to bounce, put the jobs report aside, look at this technical level 2016, 2022, your pivot in 2022, and you bounced off of it. And you notice you had support in all of this range. It had just so happened to be a perfect or a key Fibonacci retrace level in and around this vicinity in an oversold, down sloping wedge pattern. If you look on the daily chart, what we have just fulfilled is truly, truly impressive because look at this two-bar surge. One, $2 breakout. You're now trading at this 18th pivot. You've actually closed above that pivot on the daily chart, which is extremely bullish for the US dollar. This type of move is powerful and it shows that the Fed means business. And finally, the bond market is potentially waking up. Now, you do have first resistance up at this trend line as seen on the chart. Secondary resistance would be these pivots, but you have the opportunity, just like the tech stocks and the XLK and the ETFs retrace to the 100 weekly, or sorry, the 100 daily moving average, you could also see it retrace to this level on the daily chart. So that's kind of what I'm expecting. And if the dollar has a surge all the way up to 107, that would put a tremendous amount. My base case is to probably likely retrace to 105.60, and then we would need to wait for consolidation. Potentially, what we could be looking for is let me just grab my drawing tool here. So got the brush. So we could potentially have a move up into the top end of this range, and then you could look for bullish consolidation, consolidating in this wedge pattern before you could either have a move up. But we have to wait to see what that consolidation is, and that's really a long way out in terms of the dollar. But let's just focus on the near term. We could see the dollar potentially move up and continue off into a three-bar surge. That's kind of my expectations. If you look at some near-term resistance on the dollar as well, you can see that you have this pivot with this pivot coinciding with the 50 daily and these two trend lines intersecting. So in my mind, we probably see a continuation if the markets creep in fear on Monday. And we have to keep in mind that Powell is speaking on Tuesday, along with many Fed officials and members all speaking throughout the week. So there's going to be lots of jawboning. And this is probably because the markets had this euphoric rally. We saw call volumes on options coming in massively at record levels with this last rally in the markets. So crazy, crazy price action. Now, if we look at the SPY, the S&P 500, there's a few things I want to bring to your attention. If we look at the daily chart, you can see the volume has really upticked over the last couple of days on the SPY, trading above average, which shows that there's tons of distribution. Yes, there's buying pressure, but there's also tons of distribution. Looking at the weekly, the SPY hit that 100 weekly moving average and got rejected, closing back down. Now, you are closed above this hammer candle, so we potentially have to watch next week for a breakout, but that is yet to remain. So until that happens, we're at resistance. We've had a extended move, and we likely see downside price action. The big thing is, do we hold above this breakout zone or do we collapse back down on the face of yields? It's just very interesting how now the dollar is surging. And if we compare the daily chart on the SPY, January 18th is a big level. So if we go to January 18th on the SPY, which is this down red candle here, this is a large move. I think everyone mostly remembers this. They took this in the morning down, they gapped it lower, and then they reversed it, and we haven't looked back. What's so important about this day is if we compare the volume traded and this sell side move, I don't think the markets were ever supposed to be up here. We just got light volume periods, this crazy buying pressure in beaten down names via options. And a lot of people thought the Fed was pivoting and not serious about rates. You saw even the bond market saying rates were dropping, which is what we're screaming from the hills that they were most likely pricing in wrong. And that's certainly what we've got, a nasty reversion. But January 18th, this wide range red bar, all the way from basically 400 down to the low of 390, a basic $10, $11 point. If you look at the Dixie on January 18th, which was right about this wick high, you can see the wick high on the Dixie on January 18th was around 102.86. We just closed above that. So if you basically correlate that the dollar has been putting tremendous pressure on the markets, and I'm watching it intraday. And they often say correlation is not causation, which is true, but often there are periods where the markets correlate to different assets. And as a day trader watching this intraday price action, and a swing trader, you have to be aware of these market correlations because certain things move the markets for a certain amount of time and then it fades. But right now, we're seeing the dollar move these markets literally tick for tick in what I'm seeing. And I think we're going to see more sell side pressure. But back to January 18th, wick high, we just closed above that. If you look in relativity to where the SPY is trading, January 18th low was all the way here. So that wick high on the dollar was basically what sent you down to this 391 level. So if we have the dollar just closed higher than this period where the S&P was trading, and then you throw in another factor, the 2-year yield, let me just pull that up, the 2-year yield closing even higher than January 18th period. So look at this move in the yield, and this is potentially a failed bearish pattern turning into a bullish pattern, which we will discuss, and which is what we thought here since we had our upside inverse potential. We've noticed accumulation patterns occurring, and the bond trade was just looking too easy. But look at this trend line that we're coming into, and then look at this red trend line. This is what we broke. Many people thought the yields were done rising, the Fed has pivoted, rates are coming down, but we weren't buying it because you never ever got that closing confirmation. And look at this rip back into that thing. So, but since this was considerably leaning towards the bearish side and favoring a bearish breakdown, considering it's now reversed that price action and it closed above all of this bearish consolidation, not this weekly hammer, but all of these multi-days of consolidation, now that the fact that yields are even higher, if you look at where yields bottomed on January 18th all the way down at 4, we're now trading at 4.2, well north of 4. So I think we're going to see next week and the week after that, as long as yields don't collapse, I think we see the markets reprice and at least come back down to this 391 area. That's where it's more reasonably priced. And I think the downside momentum still needs to take us lower on the S&P. We've been calling about this potential fake breakout. We've warned people on the Dow. If we look at the Dow Jones on the weekly chart, we've had this potential weekly breakout over here. It looks very reminiscent of this, where we broke out, bounced, failed, bounced, and then look what we had. We've had other periods, so it's really important to go through this analysis, and this is what I'm here for. I love looking at these previous trends going back on my chart, and I keep everything saved so I have market data leading back. But look at this inverse head and shoulder people are getting bullish on, potential breakout above, no confirmation yet on the weekly time frame. And now it's likely we're going to fail just with this move in the dollar. This weekly hammer reversal candle is not only a weekly hammer candle off of major support, but it is a bullish engulfing candle, completely engulfing the last 2 weeks of downside in the dollar. So we ask ourselves yet again, could we have seen this coming based off of the charts? Yes, I did not know that it was going to be a jobs number that would cause this catalyst, but the charts were saying us that we were going to get a bounce in the dollar and we were going to get a bounce in yields. And that's certainly what we got. So I just think it's very fascinating yet again that the technical analysis is proving to be correct. And now if we look at the yields on a larger term time frame, we can see that the yields are now putting in this potential bull flag pattern, or this wedge pattern of consolidation. So if we take the lows and we adjust this now, this is actually a really nice bull flag forming that could break out, which could send us to this fake print all the way up at the 4.8 level. And this could mean that the Fed is serious about taking rates to the 5% mark. So we'll just have to continue to watch and see what transpires here. But so far, bullish in yields, bullish in the dollar, and bearish on equities. If we look at the QQQ NASDAQ also basically retracing into this wide range red pivot and selling off. The NASDAQ is potentially on watch for a little bit more upside because there is a weekly gap up here that could be filled. But nonetheless, you are at potential resistance. And with the price of, let's look where the NASDAQ was trading on January 18th. So if we look at January 18th, which was here, this was the wide range red bar on January 18th. This is where the NASDAQ should drop to at I would say the minimum. And that would be a big level. That would make a lot of sense because you would retrace back into this key trend line of support. And then it would be like, okay, can the markets hold these key areas and build a base from here? Or do we finally give it up and look to make new lows? So things are going to be interesting, especially next week. We hear from Powell again on Tuesday. There's going to be tons of trade setups. So I'm going to encourage you to stay tuned for more releases from our channel. We will be going live on Monday, Tuesday, Wednesday, Thursday, and Friday on YouTube. So stay tuned for at TC Live on YouTube, where you can catch us trading in the morning, and hopefully you can come profit with us and ultimately learn. Even if you're not trading, you can still learn to see how the market moves, because I'm learning every day. The volatility is immense. It is crazy. If we made a post on the VIX chart, you can see VIX is bouncing off support. Let's take a look at the weekly chart on VIX. So you didn't get a bottoming tail on VIX, which is interesting. It shows that a lot of people are not buying as much protection as they probably should yet. So what we could have next week is a rush into volatility, VIX protection as a hedge, and this is showing that not many people bought protection even on this little decline in the S&P. And that's concerning because it means that there's still a lot more people loaded to the long side, which is generally what could occur. But notice how we've hit this trend line many times, and this is the key trend. This is a multi-year trend line. Until it's proven otherwise, we have to respect it. And I'm respecting it because once we have pops off this level, we have big levels, and we're due for a big volatility spike. We haven't really had one. We've had a pop here and there, pop, even these moves up to 38, 33, 35 level are pretty volatile. You see some pretty crazy price action to the downside, but we haven't really had a crazy pop. And perhaps, maybe, just perhaps, maybe we're about to break out of a wedge pattern. We are trading in this wedge pattern. And as you approach the apex, which is still a long time away, you eventually favor a breakdown or a break up. One way or another, you're going to get a move. And based off of this price action, you would likely favor a pop to continue. Obviously, you could still trade at resistance here, but you would expect a pop in the short term in the VIX. And we did get a daily little reversal candle here. So that certainly is something that is positive in the short time, and knowing that support is working. So let's just continue to be very, very aware of how these markets are going to progress. If we can see anything different on the SPX, it's pretty much very similar. But other than that, I'm going to call this video an end. And I'm going to once again reiterate that I'm going live on Monday. So stay tuned for lots of action, because this should be pretty incredible. I mean, if we look at the daily chart, the DXY finished near the highs. I can touch base on Bitcoin here because Bitcoin's interesting. Bitcoin, let me pull up the other chart. Bitcoin USDT. So Bitcoin USDT did put in that daily topping tail on volume, above average volume. So we have to keep that in mind and know that that is the likely top in the short term until we have more meaningful consolidation. Now, what's important about this little reversal signal is not only this little reversal signal itself, but what's important is that you actually closed. This was your first initial reversal signal on volume. That's your daily little doji topping tail. And then you started consolidating, moving higher, but you never confirmed above it. And then you got your bigger hard sell-off, boom, that pretty much almost engulfed this candle, but you still held technical support, this upsloping red trend line, so that's a short-term positive. And then you finally got this reversal signal on volume that is basically saying that the price action is likely at the minimum going to sell off to the low end of this trend line, because you're back inside this wide range red bar. And it's very likely that the volume coming in sees even a bigger drop in the near term. Your next support would be this 21 level, but it likely even falls below that. This orange line is your previous 2017 high, around the 19.8. So that's going to be your big level of support. If I put the weekly chart on, you can see that that's your previous pivot. That's the level. That's the level that Bitcoin needs to hold. Bitcoin can still fall there and be bullishly consolidating to move higher. But I do think in the near term, you're likely going to see a move down in Bitcoin because it hasn't adjusted to the dollar and it hasn't adjusted to the yield environment, just like the equity markets haven't really adjusted. It's almost like people aren't believing it yet. So watch Bitcoin. Big support is your previous high here. If we lose that, Bitcoin's likely going to make a new low. But until then, respect Bitcoin's price action. It can potentially hold up and bullishly consolidate, build a base. The more consolidation for Bitcoin, the better. And we want to see consolidation on the weekly because you're coming up into weekly resistance points here. So, daily consolidation is good. This isn't really nice consolidation. It's upsloping. You have a sloppy broadening formation. If I draw that in the chart, connecting your highs, this is a megaphone pattern. Essentially, the more likely scenarios that you chop, back up, chop to the high end, and then boom, you have a bigger drop. So these widening, broadening formations on the daily are not positive consolidation, but it is consolidation at the minimum. So we'll just continue to watch things. But what we really want to see is, as I love Bitcoin and I do think it's going to go much, much higher, but I do think it's vulnerable to some downside risk since I am a trader. But what we want to see is Bitcoin bulls I'm not a bull right now, but what we want to see it consolidate bullishly. If this were to build a nice bull flag and consolidate even on this downsloping channel, falling a little bit to 20,000, I would love to see it fall slowly and grind a little lower on this support, or as long as it stays above this orange trend line. And then you could look to potentially catch a long play that mitigates a lot of the risk of it falling sharply. And obviously, Bitcoin does have a tendency to fall sharply. So we could be momentarily away from something big. But again, based off of the dollar, we still likely see a revaluation of assets. And based off of yields, I mean, we're talking about all the ends of the yield. We have the US 10-year we can take a look at. So the US 10-year yield is over here. So the US 10-year once again also put in a weekly reversal signal, putting in bullish consolidation. So I'm going to erase a few things here just to clean up this chart, but you can see what I'm looking at here on the chart. Look at this amazing bull flag. Initial move up, consolidation in a tight wedge formation. This is a bull flag pattern, primed and ready. Now it hasn't broken out. You're still technically at resistance if you come up here, but this is primed to potentially break out, which is what we have to be mindful of. So really that sums up the analysis of the indices, the currency markets, and what we need to know. But next week is going to be pivotal. So I'll end you on that note, and please subscribe and like this content as we try to put out educational and informative information, because we all know Wall Street is also analyzing and using as much algorithmic AI data as they can to consistently make money in these markets. And that's all we try to do, is make money in these markets so we can retire and live the happy, prosperous life that we all dream of. So take care, everybody, and we'll see you on the charts on Monday.